Welcome to the Tech Today podcast. It's your host, John Mayetta. So this is an article that we wrote recently about fixed income investors and specifically Treasury investors needing to rethink long-term Treasury yields. I talk about Treasury spreads because in the article I mentioned the difference between the 10-year yield and the 2-year. And if you look at that delta, the difference between the 10-year and the 2-year, it's typically, let's call it 1 percentage point, 87 basis points. And I feel like that spread ought to widen, because I think what's going to happen is the Fed will eventually take down rates. They can't have short-term rates as high as they are in perpetuity. We just simply have too much debt outstanding. So the short rates will come down. Fed funds will come down. The 2-year will come down. And you'd expect in the immediate term that the 10-year kind of stays where it is. And the curve, the Treasury yield curve will uninvert. Currently, it's inverted, meaning short-term yields are higher than long-term yields. And at some point, Treasury investors, 10-year yield is currently 4.4%, but at some point, Treasury investors are going to demand a higher yield than 4, than 5, than 6. Because if you look at what's happening, so this is fiscal spending versus real GDP, the year-over-year percentage change in each measure, measured at annual points. And you can see how fiscal spending, the growth in fiscal spending, how it's far outpaced real GDP growth. That spike we have in 2020 is related to COVID, and even as a spike came down, we were still spending enormous amounts. Right, in 2021, we still had an enormous fiscal deficit, as did we in 2022, as did we last year in 2023. This year in fiscal 2024, I looked last night, we were at a deficit of $885 billion. So we're almost at $1 trillion. We're slightly behind the deficit on an absolute basis that we had at this point in time in fiscal 2023, but we still have a massive deficit. And my guess is before year end, you will see the fiscal 2024 deficit outpace fiscal 2023. I think what's going to happen is the Biden administration will start to open the floodgates in the summer and in the fall leading up to the November election. And you're going to see a ton of fiscal spending here in the U.S. It won't just be writing checks to Ukraine and Israel, but it'll be writing checks here. I still think there's a chance that the better than a 50% chance that the Biden administration tries to push through another fiscal stimulus in the form of checks mailed to Americans, which of course is terrible. That's what, the minute you print the money to do that, you're inflating the money supply and causing inflation. Before an American spends $1 of those checks, you've immediately inflated the money supply, have caused price inflation, have devalued the dollar, have hollowed out the middle class that much further. So when I was a high yield guy, this was going back to the early mid-90s, even the late 90s at Putnam Investments. Nobody on the high yield team, and Putnam at the time was one of a handful of the top fixed income shops. Nobody on that team gave any consideration of fiscal policy, I can tell you. It was just, here's where Treasury rates are, here's the credit worthiness of the corporate based on our analysis. And back then, I got to tell you, the analysis was shit, because it was calling the equity analyst and see what he or she thinks about the company. Talk about lazy. But nobody gave a thought to fiscal policy. Because at some point, I can promise you, fixed income investors are going to care about fiscal policy. How do I know that? Well, because investors have a brain in their head. And number two, sovereign nations have demonstrated that they care about US policy. So China in 2024 owns less treasuries than they did 10 years ago. Japan's basically flat. So even though the United States has taken outstanding treasury issues, i.e. the treasury debt, from roughly 15 billion to 35, our largest sovereign wealth holders have kept their position, their treasury position, flat to down. They don't want to own the dollar. They don't want to own treasuries. They see how we're spending. They see the amount of deficit spending and go, they're basically the United States is destroying the value of its collateral. So the collateral, if you think about US Treasuries, the underlying collateral is the fiscal health of the nation. And so the longer we run, the longer the United States runs deficits, fiscal deficits, and the larger those deficits become, the credit worthiness of the United States deteriorates. And it doesn't matter that the rating agencies are slow to downgrade United States paper, United States debt. And anybody who knows how to analyze the credit worthiness of an instrument knows that the credit worthiness of the United States has deteriorated. You can make that case. It's deteriorated since World War II. It's deteriorated. Another step function down would be sort of NAFTA in the early 90s when we lost our manufacturing base. So we no longer make stuff here in the United States. So that obviously hurts the underlying collateral. We had maybe another step function down around 2009 with QE and the related government bailouts of the banking system, printing money out of thin air at scale. That was a massive step function down in the credit worthiness of the United States. And we did it again in 2020 with COVID and have perpetuated that spend level, for the past 4 years now. Just absolutely on an unsustainable fiscal spending path. And so at some point, Treasury investors are going to say to themselves, yeah, I know the spread between the 10-year and the 2-year yield has been roughly 1 percentage point historically over the past X number of years. But I've got to start to think about the United States from a fiscal standpoint, because it is spending far more than it is taking in tax receipts. And at the end of the fiscal year, when it works to plug that fiscal gap by issuing new Treasury securities, it's not like it was 10, 20 years ago when most of those new issues or all those new issues would be purchased by Japan, China, and other countries. Now we have the Federal Reserve has to step in and print money to buy a portion of those Treasury auctions because there's not enough demand out there. Right? We saw that this fall, early this winter, when Treasury issued a couple trillion worth to offset the deficit from fiscal 2023. And we're going to see more of that. So either the federal government goes on a radical fiscal spending diet, or it continues to run deficits between 1 trillion and 4 trillion, let's call it, because we were up over 3 in 2020. And I don't want to call 2020 an outlier anymore because it's just these guys in Washington they're like, hey, it worked well in 2020. We spent, the sky didn't fall. Let's continue to run massive deficits. Of course, the sky is falling in the form of price increases, which Americans know is much higher than what's reported in CPI. There is no free lunch. Debt does matter. If you issue debt and live above your means as a country, there's a penalty to pay, and that's in the form of higher prices for goods and services. So I don't know what the right number is for the 10-year Treasury yield. I don't know. It's going to be a function of how the United States continues to spend, how large of a fiscal deficit is the United States willing to absorb each year for the next few years. And my guess would be, so I'll put this out there. I would guess that if we continue along the current path of spending for the next 5 years, and when I say spending, I'm talking about the deficits. If we continue to run annual fiscal deficits north of $1 trillion for each of the next 5 years, that we will see a 10-year yield north of 7%. And if we continue to spend at this current pace for the next 10 years, we will see a 10-year Treasury yield north of 10%. And at some point, the 10-year yield will get high enough, maybe it's 7, maybe it's 10, to where it will slow fiscal spending because Treasury won't want to issue long bonds if the yield is going to be close to double digits or double digits, because that debt will just be too much to pay off. So at some point, the market will enforce fiscal discipline on Washington, D.C., on Congress, on whoever's sitting in the Oval Office. Discipline will be forced upon them because we simply won't be able to issue long bonds or even short-term paper at exorbitant rates. And the market will eventually reflect a rate that is aligned with the level of risk, fiscal risk, that underlies these Treasury issues. That's all for now. See you next time.